Good morning. This is Butch Shorrock, Options University, Monday, May 28th, 2012, and a happy Memorial Day to all of you. Access to this webinar is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit, and we want you to take responsibility for your money. After all, who loves your money more than you do? With that, let's take a look at the week that was, economic announcements that took place during the week. Really were not all that many. As Monday, we saw little or nothing take place in the market. Last week, we saw that Tuesday, we did have some existing home sales. And we also on Wednesday had more home information that came up. These things do not move the market very much at this point because no matter where they move to, they got a long way to go before they can lead the economy out of this deluge that we're in. On Thursday, we saw jobless claims come up at 8:30 a.m. PMI manufacturing index also came in at 9. Jobless claims this week came in at 370,000, which is right on par with the 365 initial claims that had been widely forecasted. And so, therefore, not a big move out of jobless claims, as we've showed more strength in May, as we've had lower jobless claims than we did in April. All right, home sales in April hit an annualized rate of 4.62 million, while the new home sales hit an annualized rate of 343,000. So not bad for home sales. We got mixed numbers coming out of it. But the real news for the week came in on consumer sentiment on Friday. This comes out of Michigan, and it has made a big surprise improvement to 79.3, which stands as a 4-year high. Obviously, consumers are far less concerned about the euro contagion and are more concerned basically on job growth. They're concerned on housing market. They're concerned about falling gasoline prices. These are the things that shove the consumer confidence up to its highest level since October of 2007, which was 2 months before the onset of the Great Recession. The euro acted as a trading catalyst for most of the week, as there was plenty of news out of Europe, plenty of gyrations on the euro, and there were concerns aroused by a former Greek prime minister who indicated that the country may be considering an exit out of the Eurozone, which he said basically thought would be quite a loss to the Greek people. And so that caused one of the knee-jerk reactions which took place on Wednesday, which we'll look at in just a few minutes. On the corporate side of news during the last week, we saw home improvement retailer Lowe's reported stronger than expected earnings, but did not forecast great things for the future, as the guidance was a bit of a disappointment. Fellow retailers Best Buy, Urban Outfitters, and Ralph Lauren were also in play during the week, as they had good news and moved the market in more of a positive direction. Dell, which had its worst one-day drop in more than a decade to set a new 52-week low in response to a disappointing quarterly report. Hewlett-Packard, on the other hand, was greeted with a positive response following its latest earnings announcements, resulting in the stock's best single-session percentage gain in more than a month. Yahoo made headlines with its decision to sell half of its stake in Alibaba, which is a Chinese company. J.P. Morgan opted to suspend its share repurchase program, but stated that it intends to maintain its dividend, as J.P. Morgan certainly has been in the news, with Jamie Dimon leading that news as we hear about their big trading losses. The contagion on Wall Street still continues. Have you ever noticed that those losses seem to come out of that London market an awful lot when they have these huge losses? Must have different rules there or something. It's time they figured that one out. All right, as we come into the new week, Memorial Day week, we are closed on Monday in honor of our veterans. And then on Tuesday, we see that we have consumer confidence at 10 o'clock after the market is open. And then on Wednesday, we have the job cut report from the Challenger at 7:30 in the morning. And then we have more new housing news on Wednesday. Not a big day on Wednesday as far as moving the market. And then we get to Thursday, May 31st, the end of the week. And as we come to that day, we see we have GDP, We have jobless claims, which takes place every Thursday morning at 8:30, talking about the week before and the number of unemployment claims that were made. We have the Chicago PMI after the market opens, and we have the ADP employment report for the week. So Thursday could have a day where it could be moved by news that's taking place. And then as we get into Friday, June 1st, we see that we have the employment numbers coming out at 8:30 before the market opens. These are the numbers that tell us exactly how many jobs there were in the month of May. Certainly capable of moving the market. And then ISM manufacturing index at 10 o'clock. So we see we've got plenty of news as we go into the end of the week in the economic announcements. So keep your eye on these as they could affect how you trade your account. All right, with that, now let's take a look at the SPX for the week. And we see that the action in the week was one where we had an up cycle. After having 15 days in a downtrend where we changed trend, we were trading in a sideways trend for the last couple months. Once we broke out of this yellow zone into the lower level, we have now changed our trend to a downtrend. All right, we will stay in a downtrend until we have our next move. The next move and the next market we're looking for is a sideways trend. In order to get a sideways trend, we need to trade sometime below the 30-day moving average, which is this one right here, and sometimes above the 30-day moving average. Until that point, we are in a downtrend. So if we continue in the downtrend, when we hit this moving average, the market should bounce down. All right? In order for the market to bounce up, it needs to hit this moving average as it extends out and start trading above the moving average. All right, we'll see whether that happens or not. Meanwhile, remember, as we trade in this new zone, which is going to be our new summer zone, we'll see this line come down, and it will hit somewhere in the median area across here. All right, and when it starts trading above and below the moving average, our trend will have changed to a sideways trend. Currently, we are in a downtrend. We are in an up cycle in a downtrend as we have bounced off the bottom, which did not hit the 200-day moving average. That's the SPX as it exists on a larger scale. Now let's go in and look at it more for the past week and see what happened during the last week, as we see that in spite of all the negative Euro news, the market finally bounced, getting to this huge oversold situation, and we got a big move where we got cheap stocks being bought on Monday, and we got short covering taking place as we ended up with this big candlestick on Monday. And then as the rest of the week went on, we had much smaller moves to the upside, but nonetheless continuing that up cycle. The big day as far as the large range day was Wednesday, as we had that big news come out about Greece leaving the Eurozone. And what happened as the day went on, notice the kind of candlestick we have here. And what happened was the bears tried to take control of the market as the day went on, and when it was all said and done, the bulls shoved it right back up to where the market basically opened, as we ended up with Thursday and Friday with much smaller moves and much smaller moves in the overall market through the day as we got some consolidation. So what happens is a pattern that happens often is first we get expansion and then we get contraction where news overpowers everything, but we still continued our up cycle in this overall downtrend, looking at how far we're going to bounce as we bounce off of this initial bottom, and we'll see where our trading range is going to be for the summer. Is it going to be sideways, or is it going to be a continuation of the downtrend? Time will tell. At the moment, we're in a downtrend, looking for our next trend, which will be a sideways trend. The old rule of go away in May certainly fit for this particular year of 2012. Let's take a look at the at the Dow, and we see the Dow looks very much the same as the S&P. Notice the Dow also did not hit the 200-day moving average. The candlesticks look basically the same, where we had the downtrend, change in trend from the sideways trend, and now we're in an up cycle in a downtrend. The Dow following the S&P, or vice versa, whatever way you want to look at it. NASDAQ also had a huge pullback, didn't quite make it to the 200-day moving average, and we see that it is consolidating as it had its expansion day and then some contraction A little more weakness on Friday than the other market out of the NASDAQ. Next, let's take a look at the Russell 2000, which did hit the 200-day moving average, actually went below the 200-day moving average, but never really closed below the 200-day moving average, as the 200-day moving average acted as support for the Russell 2000, and we see that it could potentially help lead us up. I always keep an eye on this, as many times it can give me a forerunner to tell me where the other markets are going based upon its relative strength or weakness to the other markets. Russell 2000 can be an indicator that can use to make sure you're on the right side of your trades. The VIX, as we can see, continued to trade outside of that 20 range. Remember, 85% of the time the VIX trades between 14 and 20. We're still outside of that range, but heading on down, as we may have had a good deal of the volatility already take place, and we'll see if we enter back down into this more normal zone for the VIX to spend the summer in. This occurred because we had a change in trend, and that always will be indicated as some kind of move in that fear index. All right, with that, now let's take a look at the bonds. See that the bonds have moved out of its trading zone that it spent basically 3 months in. Bonds hit another high as we saw the market pull back. We'll see what happens to the bonds as the market gains some strength and starts consolidating. I would expect that the bond market will come back down into its more normal trading zone. Again, that remains to be seen, but potential here for a movement on this ETF. We're looking at the TLT. The TLT is the ETF that represents the 20-year Treasury Bond Fund. All right, let's take a look at another exchange-traded fund, and that exchange-traded fund will be the XLFs, which is the Financial Spider Sector Fund, and we see that as the overall market pulled back, big surprise. So did the financials. Remember, a market that goes up with the financials participating will really not usually maintain its steam. The financials basically came down to that 200-day moving average, and we're now seeing a little bounce in spite of what happened, even with JP Morgan helping leading the financials down with its news about its trading losses. It still bounced prior to that 200-day moving average. Keep an eye on the financials, as it will follow, in general, the overall stock market in most instances. USO, United States Oil Fund, which is another exchange-traded fund, which can allow us to help trace oil and where it's going, began to consolidate as we finished the week. There's the week that was, and we see that we're laying in some kind of support there. Potential bounce on USO, you might watch for that. As we see that oil has begun to sell off, we've actually seen the gas prices go down too, which is certainly something that America focuses on with their love of the American automobile, I should say, in this day and age. Gold, represented by GLD, the Spider Gold Trust, another exchange-traded fund, we see has been gyrating and trading with a range of between 155 and about 148. And we see that we have a sideways zone on that, one you might take a look at for potential trades for those of you that have strategies for sideways trending stocks. All right, next let's take a look at the volume on the SPY. And we look at the SPY because it is an exchange-traded fund that does have volume. And notice as this thing came down basically around 15 days, well, you see that we had a volume surge as we laid in our bottom on this Friday, and then we started moving up on Monday. Huge volume that day where we had the big fight on Wednesday over the Eurozone, where the market and the bulls prevailed, and we see that now we're consolidating a little bit. One might expect that we're going to continue up a little bit more unless some great news comes out of Europe to help define that summer trading zone. So looking at the volume, this gave us a climax day as we saw the volume increase on that day. Two big numbers, certainly more than 50% of the average volume for the SPDR, the ETF for the overall market. All right, now for those of you that are gold members, stick around. We'll look at our momentum stocks and look at those charts, see if there's anything, how they followed the overall market, whether there's any opportunities there for us. For those of you that are not gold members, and would have an interest in viewing more free videos from optionsuniversity.com, you can go to www.optionsuniversity.com/free gold and see where you can see some other videos that we produce for you. With that thought, gold members, hang on. We'll be back in a minute. And for the rest of you, thank you for being here. This is Butch Chorak, Options University, Monday, May 28th, 2012. Trade wisely and have a happy holiday.